I hope my screen is visible. Is it visible? Can anyone?
Yes, sir.
Yes, sir, it
Sure.
is visible.
Sure. Thanks.
Sir, can you share this your notes?
Yeah, I will be sharing this today only.
Kind of like formula sheet you have made it for us, sir.
Yeah, I just for quick recap. So I will be first recapping some key concepts which we learned in week 1 to 4, and then I will be solving some questions, and then I will be taking your doubts and questions if there are any. Okay. So in the first week we gave a general introduction about like what this course is about, and from the second week onwards, like we started discussing some concepts like future values, present values, capital budgeting rules, annuities, perpetuities. So future value of any cash flow, yeah, any amount which you have today, what will be its value after a certain point of time. So for that, like we can calculate future value if we know the interest rate which is there. So for example, if a bank says it is giving you 5% rate of return, annual rate of return, and you have 10,000 rupees in your bank account, then this formula is used to calculate like what will be your that 5,000 rupees will become 10,000 rupees will become in 5 years or 10 years, whatever amount you are holding that into your bank account. Okay. So this is the general formula, and I have given an example. So for example, if you have 1,000 rupees, and if prevailing interest rate is 10%, then in 1 year your amount becomes 1,100 rupees. Similarly, in 2 years it becomes 1210 rupees. Okay. And here T is the time period and R is the rate of return, which like we are assuming that this is constant for coming periods. And the reverse of that concept is the present value. So if you have a certain stream of cash flows, like in first period, second period, third period onwards, so what we are doing in present value concept is like we are essentially bringing all the cash flows in today's terms so that we can compare them. Okay. So for example, if I am earning 10,000 rupees after 3 years, and if prevailing interest rate is 10%, then what will be the present value of that? That will be 10,000 divided by 1 plus r, that is 10% to the power 3. And here I have given an example of like 1,000 rupees after 1, 2, and 3 periods if interest rate is 10%. And you can see like the farther away I am getting my money or getting my payment, lowest is its value in today's terms. Okay. And another concept like which we learned is the power of compounding. Like what is power of compounding is when we keep our amount in a certain investment or a bank account, anything like that, that earns some interest. And if we hold that longer, then we earn interest on that interest also. So our interest gets compounded. And through this, like our payment is like becoming larger and larger, and if we increase the frequency of compounding, that also impact our final value. And in week 2 live session I gave examples of like if my interest is annually compounded, biannually compounded, or monthly compounded, and daily, and then continuously means like it's at every moment your interest is being compounded. And if we are taking the continuous compounding case, then this is the formula which gives me the future value, and the reverse of that will give me the present value of my future cash flow, and this is the future value of my present cash flow. Now, like there are two important cash flow streams which occur in our day-to-day life. One is annuities, another is perpetuities. Perpetuities are the stream of cash flows which like goes forever. Like it starts next period or present period and it goes on forever. And we are assuming like we are getting fixed payment in each period or a continuously growing at a constant rate, this type of payments. that we call a perpetuity. Perpetuity means like payments are perpetual. And a very good example of that is the stocks or the shares which we are holding. So there is no maturity of that instrument. So those are perpetual kind of investment instruments. Okay. And the present value of a perpetuity, which gives me C amount of constant payment each period starting next period, and R is the rate of return which is prevailing. Then this is the formula which will give me the present value of my perpetuities. And this perpetuity formula is used in like company valuation or the stock valuation, and we have done some examples of that, and I will be taking some more later in the class. Another similar concept is the annuities. Like annuity is a perpetuity which do not last forever, but it lasts for a certain period of time. So, for example, if my payment lasts for only 30 years, then it is a annuity. So here, like this is the formula for the present value of a annuity, which gives me a constant payment of C every period for T amount of periods. And if prevailing interest rate is R, then this formula gives me present value of my annuity. And these annuities are used in like loan repayment, or like in day-to-day life we hear about like the EMIs calculation. In that concept, this annuity formula is being used, and I will be taking one of that example today. And in week 3 we started our discussion on the capital budgeting rules, which says like which project should be taken up and which project should be avoided. So there are four major types of capital budgeting rules which we discussed. First one is the net present value. What we do in net present value is like we calculate the present value of all the cash flows, like the cost as well as payments which we are receiving. We calculate the present value, then we sum all of them. If this NPV coming out to be positive, then that investment opportunity is like investable. You should go for that. If it is negative, then yes, you are making a loss from that and you should not invest in that. Very simple capital budgeting rule, and this is the one of the most powerful and most like widely used capital budgeting rule throughout. Second, we use the IRR, internal rate of return. So IRR is nothing like the simple definition of that is like the rate of return at which your NPV becomes zero. Okay, and the rule which we follow for capital budgeting is if this IRR is more than the prevailing rate of return, then that project is investable. Third, we discussed about the profitability index, which is the like it is applicable on a certain type of projects only, like the projects which have like the first in the present period you are incurring the cost, and all the future cash flows are positive. That means you are receiving the payment. If this condition is not satisfied, then this concept cannot be applied. And this is the formula, like the future present value of all future payments and divided by the cost today. If this index is more than 1, then your project is profitable, otherwise it is not. And the fourth one is like it depends on the individual type. Like payback rule says like the how fast or how quicker you are getting your payments, your investment or your cost, you are like the how fast your cost is being recovered. That is the payback rule. Okay, and the project which has the shortest payback period, that is the preferred by this capital budgeting rule. Okay, so these are the concepts which we discussed till week 3, and we have some brief discussions about like the annualized rate of return, total holding rate of return, and the time varying rates of return. So till this discussion, we have taken interest rates to be constant and to be known throughout, etc., etc. So annualized rate of return is like, let's suppose you hold some investment for 20 years and they turns a total rate of return of 100%. So your money doubles in 20 years. So what is the annualized rate of return that you earn? Annualized is like you are calculating your rate of return in a per year term. Why? Because again, like most of the interest rates are termed in the annually or the yearly terms. That's why we are interested in calculating annualized rate of return, similar to like why we calculated the present values of any cash flow, because we want to compare them. Okay, so this is the formula which we use for the annualized rate of return. And I will, so for example, like as I said, in 30 years you have 100 rupees, in 30 years that will become 500. So what is the annualized rate of return that you earn? So if I use this formula, if R is that annualized rate of return, then my rate of return is 6.15%. And time varying means like the in the previous discussion we have assumed that the interest rates are fixed in each period, like the same interest rate in each period. But in general, that is not the case. So it may be the thing that in the first year, like in year 2025, the interest rate is, let's suppose, 7%. In the second year, it may be 8%, and in the third year, it may be 5%. So it may vary. So what happens then, the present value formula like changes according to that. So if these are the rates of return, then this is the present value formula which you have to use.
Sir, in the last question, my rate is coming to be 5.51%.
Which one? This one?
Annualized rate.
So please check that. So I will check the calculation. So you should, so it should be like R would be 6 to the power 1 by 30 minus 1. This will be the final answer. So please check that if that should be this one. If it is not, then yes, I will check later on and I will rectify it. Okay.
Yeah.
And then the week 4, we discussed about some concepts like inflation, yield curve, and maturity and duration. Maturity is like the what is the time to the last payment, simple. And duration, like we are incorporating the payments which we are receiving into that maturity concept. And the formula for duration is this. And there is another type of duration that we call Macaulay duration, where we replace this CT to be present value of these CTs. Then we call that formula to be Macaulay duration. And
But to
inflation,
calculate the macular duration, we need also the interest.
yes, yes, because there you need to calculate the present values. So for that you need your rates of return. Inflation is nothing just the change in the price level. And this price level, we calculate this price level in the form of CPI, consumer price index, wholesale price index, or the GDP deflator. And the pros and cons of these three price index is discussed in the lectures. You should note that like why CPI is preferred in, and what are the benefits of GDP deflator and what are the cons of GDP deflator. Like these are discussed in the lectures and slides, so you should know that. So, and also we discussed the concept of real and nominal. So real is the in terms of goods, and nominal is in terms of currency, like or the prices. Okay, so we will discuss like what are the formulas, and we will solve some questions on this concept. And yield curve is nothing but the graphical representation of like the relation between the rates of return and the maturity. So it is a curve between annualized rate of return and the maturity. And in general economic scenario, it is generally the upward sloping yield curve. Why? Because longer you hold your investment or your, then it should be earning higher interest because you are taking higher amount of risk, because things are more likely to change in longer period than in the shorter period. Okay, this was the main line of topics which we had in our till our week 4 discussion. And so let us take some examples. Okay, so first one says, like, suppose a project yields like rupees 1000 each year for 5 years. Then it asks you, like, what is the present value if the prevailing interest rate is 10%. Okay, then present value, like, we can apply the formula, and like in the first year you want 1000, second, third, and fifth, and I have calculated the present value, and this is the present value which I am getting. Similarly, like if it asks you, like, if the cost of this project is 3500 today, then to calculate NPV, like I have to incorporate minus 3500 here, and then some all of that. So all of that is this. Then NPV is coming out to be positive. So that means, like, if cost of this project is 3500 today, then it has a positive NPV, and it is an investable project. Similarly, like this qualifies for the profitability index criteria, because first one is the cost and all future cash flows are positive. So profitability index is the present value of future cash flows divided by the present cost, that is 1.083, that is greater than 1. So through this criteria also, this is a profitable. And for payback period, like in how much time it takes to recover all of the cost. So the cost was 3500, and in payback period, like generally we do not incorporate the discounting. We generally sum up all the payments. So 1 2 3 4 fourth, in the fourth year you are getting like the more than 3500, so that means your payback period is 4 years. There may be like some questions in the exam, so I think you have access to the previous year's quiz one, so the pattern would be the same. And there were questions like, you have given different types of projects and you were asked, like, on the basis of this criteria which project should be selected. So for example, you have given 4 or 5 types of project, and you will be asked, like, according to payback rule, which is the project which should be picked up. Okay, so this is the here we are like the recapping the concept of perpetuity and annuities. So let's suppose there is a perpetuity which the assures a payment of 1000 rupees each period starting from next year, and the payments goes forever. So this is a perpetuity. If the prevailing interest rate is 10%, then what is the present value of this perpetuity? So we use the simplest formula of the constant payment divided by the rate of return, that is 10%. So by that formula, so this is the present value of your perpetuity. So why this present value is important to us? Like, because we can compare this with the what is the cost or what is the investment that this type of project requires you to make. For example, this type of project comes and it asks you to invest 12,000 rupees, then you should be aware, like, yes, this is, if it is asking me 12,000, so it is asking me higher than its present value, so I should not go for that. At the same time, this investment opportunity comes and it asks you to invest 8,000 rupees only, then yes, you can compute the present value and you can see, yes, it is asking me less, so it is profitable for me, and you can invest in this type of projects. Now an extension of that is, like, if payment also grows at a rate of 2%, then what would be the present value? Then the formula is upgraded to this, and we incorporate the growth rate of payments in the formula, and formula becomes constant payments divided by r minus g, and through that we get like the present value of this type of annuity is 12,500 rupees. Now, like, this was the example of annuities which lasts forever. But if the project says like it will only give you payments for 25 years only, okay, then you can use the formula for the annuities. So I have given the simple annuity formula above. Here like I am continuing this question. So it is a growing annuity case. So the payments grows with 2% and the rate of return is 10% and it gives you 1,000 rupees per period for 25 years. Okay, so this is the formula for the growing annuities. I place all the values R 10%, Z 0. Like R 10%, G 2%. If I place all these values, then my present value of this annuity, which lasts for 25 years, that is 10,607 rupees approximately. So if you have any doubts in these annuities or perpetuity concept, please let me know. Okay, let's discuss a bit about like the varying rates of return or the annualized rate of return. So let's suppose it says like a project like which says like it will give you 8% in the first year, in the second year it will give you 12%. It is not giving you the same. So the question is asking you like what is the total return that you have earned in these 2 years. Okay, so for that, like if it would have been same for 2 years, then your that 1 plus R02 in both years, if you have earned 8%, then it would have been 1 plus 8% square. Or if it would have been 12%, then it would have been this. But it is time varying. So this is the total two period rate of return, that is like 20.96%. Now it says like let's suppose you earn this amount of total rate of return in 2 years, then what is your annualized rate of return? So annualized means like if you earn same rate of return for all those years, then your total holding rate of return should become this one. So I'm using that concept. If R is my annualized rate of return, then 1 plus R square, that is 2 years return, that should be equal to this much. So from that, like it is coming out to be 9.98%. So here I have covered both like the annualized as well as time varying rates of return. Okay, now let's have a look at some of the applications of perpetuities and annuities. So perpetuity concept is used in like the company valuations or the stock valuations. Why? Because we assume like generally the people who value the companies or the stocks, they generally assumes like the stocks are perpetual or the company is going to last forever. It is not going to like the exist in any time. It may it may cease to exist, but like generally it is like supposed to last forever. So that's why in like the in take like the to set a benchmark, we use this perpetuity concept. For example, a company which makes a profit of 1 lakh rupees in next year and its profit is expected to grow at 4% per year and the cost of capital is 8%, then what is the firm's maximum valuation? So maximum means like this company is never going to like the vanish. Or so in that case, like I can calculate this is a growing perpetuity case in that case. So this is the maximum value, present valuation will be in the present terms. So if you guys like the have seen the Shark Tank type of shows, there all those startups, they show their like what is their valuations. So these types of concepts are used there in like in order to calculate their valuations. So it would not be this simple. They are like incorporating other informations also, but we are taking like the simplest possible valuation technique. So that is this. Okay. So they take all their projections. So if I am giving these projections about a company, then this is the valuation. So valuation is 25 lakh for this type of future cash flows. And at the same, like the, let's take an example of stock valuation. So a company, it can be any company, maybe Reliance Industries. So it is paying like the rupees 20 in form of dividends from next year, and the investors assume that this dividend is going to grow at a 2% per year, and the cost of capital or the rate of return is 7% in the market. And then what is the stock price according to that investor which is assuming this? So he would price that to be like the, so this, why like we are using the perpetuity formula? Again the same thing, like the stocks have no maturity, so they last forever in many of the cases, and that's why we are using this perpetuity formula. And stocks are a stream of cash flows which pays you dividends perpetually. So if I use that formula, then the price of this stock of stock of this company is coming out to be 400 rupees. Why this is like the relevant for any investor? So from, if I have this benchmark, then I can make my investment decisions. So if the present price that is there in the market, that is more than this benchmark, then it is overpriced. Okay. So if a stock is overpriced, then it is profitable if you sell that. If you are holding that, then you should sell it. But if you are not holding, then you should not go for like the purchasing that type of share. And if its price is less than 400, then you should go and buy, and you can earn profit on that, because it is supposed to. Because if this is the true fundamental value, then yes, stock price would rise in that case. And if it is same, then we call it to be fairly priced. Now, like as many of the questions were being raised in the like the earlier discussion also, like what type of questions will be asked for the internal rate of return calculation. So I think this time we will be giving like the only single period. So for example, one example of that is like there is an investment which costs you 100 rupees today, and it is supposed to give you 121 rupees in 2 years. So it may vary like 2 years, 5 years, it may vary to any number of periods. Then it asks you like what is the internal rate of return. So you can, internal rate of return is nothing but the rate of return at which the NPV becomes zero. So I am using that formula, and from that this internal rate of return coming out to be 10% in this case. Now coming to the inflation case. So first, to calculate like the in questions, like we have practiced on like the calculating CPI. So to calculate the CPI, important concept is the base year concept. So what is a base year? Base year is like we are making a particular year's price level to be our base or our benchmark. So on that base year, we are like the, we calculate that index and we fix that to 100, and we will calculate all other years price level in comparison to that level. Okay. So for example, if the base year is 2012, which is the case with RBI, so RBI has given us number in the base year of 2012. So in that, according to that base year, CPI in 2023 is 120, and CPI in 2024 is 125. So it should be like the in same month. So for example, in May 2023 and May 2024, it is this. Then what is the inflation in May 2024? Okay, then we will use the inflation formula, like the present price level minus the past divided by past, and from that, like, we are getting the inflation rate is 4.167%. Now, like, the relation between nominal and real interest rates, that is like, so it gives you like the nominal interest rate is 7%, inflation is 6%, then what is the real rate of return? So there were two things were discussed. So this is the approximate formula and this is the exact formula. So you are supposed to use this exact formula until unless you are asked to use or asked to approximate your answers. Okay. So you should always like the take this formula and you will always come up to the correct answer. Okay, so if I use the approximation, that is the real interest rate is nominal minus the inflation. Through that, I am getting 1% is my real rate of return. If I use the exact formula, then the real rate of return coming out to be 0.94%. So there is a slight difference here because like here we have used approximation. This is the exact real rate of return that is there if these type of conditions are there. And lastly, like the application of annuities. So I am giving you an example of how banks calculate or how can you calculate your AMIs if you take a loan or if you buy a product, and you know like what are the interest rates that are going to be there. Or when you go to a bank and ask for a loan, that's like they give you the quotes about the interest that they are going to charge. So you can use this concept and calculate EMI upfront, and or you can compare your EMIs which banks are charging and what is coming to by your calculations. So for example, you go to a bank and take a loan of 2 lakh rupees and you promise to pay in EMIs in 5 years, and banks are charging you like the 20 quoted interest rate. Quoted means like in banks quotes, like you can by annual you can calculate monthly by just dividing it by 12. So monthly interest rate would be 12 by 12, that is 1%. Okay, then what would be your EMI? So here, so this EMI is a fixed stream of payment that is going to be there. So equal monthly payment which you are going to make for 5 years, that means 60 months, and the rate of return is 1%, time period is 60, and you are making a constant rate of return, that is C, which I want to calculate, and its present value should be 2 lakh rupees, which I am taking today. So if I apply this formula, I come up to my EMI value or the constant payment value, that to be 4,449 rupees approximately. Okay, so these were the examples which I had. So now I will be opening the floor to you. If you have any particular doubts on any type of concept which you want me to cover, then I will be covering that today. And these are the
Yeah,
some
sir.
logistical. So in quiz 1, it is going to be held on this Sunday, and syllabus is from week 1 to week 4. Whatever we covered, that will be part of our syllabus, and pattern will be MCQ. There will be 25 MCQ type questions, and I think you will be having 1 hour for your quizzes. Correct? Yeah. Yes.
Oh, sir. One problem, sir. Just I ask you to solve that from
Okay.
the
Yeah.
PYQ. It's not coming, sir. Not matching the answer. Shall I share?
No. I will have a look.
Sir, the questions you discussed just now, it covers all the patterns, right?
Yeah, I think but it is a good idea to go through the slides because there are going to be some like the conceptual questions also.
Hmm. Okay.
So for that, like, you should have a look at the slides mainly, not going through this lectures, but you should look at the slides and learn about the concepts, like what are the different concepts regarding
Ah,
internal rate of return or other types of yield curves,
ah,
GDP,
yeah.
inflation, etc., that you should know.
If you look at the slides, right, the name of the slides are a little bit confusing, sir. Some of them are like CF and some of them are FF. And let me know what does that stands for.
So CF is corporate finance and FF is also like finance related some concept. I don't know like why those are termed like FF, but if you are having any, so I will ask the like the POD team to like change the file names accordingly. Like so all of them would be CF, then underscore, then the week name, and if there are multiple slides, then there will be a ABCD type of letter there.
Oh, okay, sir. Okay.
Okay.
So even
So
the FF slides are also there for our this thing.
yes.
Okay, sir.
So FF slides are, I think for week 1 to 3, the slides are named FF underscore something. And from week 4 onwards, these are termed as CF underscore something. So FFs are also called.
Okay, sir.
So it's question number 260.
Yeah, I will be taking. So it is about like the calculating the future value. So it is the concept of like if you start investing some amount, then in how much time or in how many period you will become you will accrue a certain amount, correct? This type of questions you are asking me.
Yeah. It's specifically I'm reading out. I don't know why its answer is not coming. It says that you deposit 100 rupees
Per day.
daily, each
Yeah.
day, in a
So
bank
you
with
deposit
8% annual interest.
100 rupees per day. Okay. I am
Annual in,
writing down all the things here. Okay.
yeah.
So because like let's suppose you are addicted to smoking and you want to quit smoking, and so if
Hmm.
you quit smoking, you are saving 100 rupees and you are saving it to a bank account. Okay.
Yeah, with
So now question
8%
asks,
annual return,
yes, 8%
annual interest compounded daily.
annual interest compounded daily. Okay.
Uh, then how much money you will have in 5 years?
It also says like we are using the banking convention. So if I want to
Hmm.
calculate daily interest rate, that would be 8% divided by 365. Okay. And so how much money will you have in 5 years?
Right.
Sir, this compounding thing that we have to compound it daily or yearly or monthly, this will be mentioned in the question, right, sir?
Yes. So here what you need to do, so you are calculating the future value, correct? So first day you have 100, in the second times like you have 100. So
Excuse me, sir.
so
5 years will also be multiplied by 365.
yes.
Excuse me, sir. Can I use e to the power of RT?
No, here it is not saying you continuously compounded. So
Okay.
It's
you are
daily
not
compounded.
supposed, yeah, it is daily compounded.
Suppose if I use R as 8% divided by 365, and T as 5 into 365.
Yeah, you can check like yes, in this case you may get approximately the same answer, but you will not get the exactly same answer, I think.
Okay.
I have not checked like whether by continuous compounding we are getting the same answer or not. But yes, as we discussed, like if numbers are very small, then continuous compounding and the daily compounding gives you almost the same numbers.
Yeah, the difference will be very small, sir, but it's not the exact because this is not continuous compounding. This is
Correct.
daily compounding. So that
So
the
there will be a
E-
slight difference in the numbers.
yes.
So here like you are having 100 investment for 365 multiplied by 5 this many periods, and this is giving you this rate of interest. So and R is equal to 8% by 365. So this is simply the future value where we use the sum of GP concept. So this is a sum of, like, there will be a geometric progression. The sum of that is like 100, then plus 100 into 1 plus r, 100 into 1 plus r square, and this type of, and this will be for these many periods. So this is a GP. So GP progression formula is, so according to that, so I think that would be r is 1 plus r to the n. This is n. If I'm writing this to be n minus 1 on 1 plus r minus 1. I think this formula will give you the answer if in the daily compounding case.
No, answer is actually not coming. That's the main case.
Answer is not coming.
No,
So
it's not matching.
So that I have to check. I think the answer matches. So I think we check the calculations while preparing the exam. So it should be matching. So let me check.
Okay.
And any other questions if you have, meanwhile you can like to let me know.
Sir, I had two general questions.
Yes.
The first one was, sir, will we get questions where we have to type the answer, or will it be selecting the option based only?
It will be selecting the options only in the quiz, in the first quiz.
Okay, sir. And so the second question was that in week 1, we have the last few lectures which are on financial crisis, then rating of the assets and cases based on that. So, sir, in those things, do we have to actually learn that how the cases had progressed and what happened periodically? So, should we memorize that, sir, or can we just go through it once and that will be sufficient?
So you should not memorize, but like the basic concept, like I think there were some questions in the week 1, like where there were some examples like how securitization was done. So if there were 2 types of bonds, then
Yes, sir. Yes,
how
sir.
you created different tranches. So you should have that concept, and how like junior and senior tranches were different. Those concepts you should be aware of. Like some questions maybe on that, I think. So I think you have the previous terms quiz with you. So I
Yes,
think
sir.
you should go through that and you will have an idea like what type of questions can be asked from them.
Yes, sir. Thank you, sir.
Sir, I think is it our the CF is floated for the second time now?
Yes.
I mean, there's only one previous quiz
Yes.
paper,
Yes.
right?
Yes.
Okay. Thank you.
So here, in this formula, the R is basically 0.08 by 365, right?
Correct.
It's not the answer is what match. I don't know why. The bottom one basically is only R, because 1 plus R minus 1 is only R. So it's P by R, means
It is-
C by R in
It is matching for me. I have computed this formula. So the total N would be like 1825, correct?
Yeah.
If I have
Yeah.
calculated using my calculator, and it coming out to be the same, which is marked there, 224365. I think you should check once again, like because there are multiple numbers. So the idea, like in the previous term, like we had an idea, like we gave some simpler questions. So we gave 2-3 these lengthy calculation type of questions, but like we didn't have the idea that you need to like by mouse you need to type in the numbers in the calculator. So this time, like, we have not given these types of calculations, but bit simpler ones are given.
Okay. Sir, I had one more query.
Yes.
If you had our means weekly slide, if you go to that yield in your week 4, that yield curve part, if you
Yes.
open that slide.
Yes.
Sorry, before you go ahead, this question, what is the answer for this question? Please, if you can write it.
Okay. So the answer would be So the exact answer would be like this is the option. The exact answer would be like after the decimal place. This is the amount which I am getting.
Okay.
Okay. By using R to be this, N to be that is 1825, and I am using this like the GP progression some formula, and that I am getting. Okay, let me see the so week 4 slides. So we in the yield curve, what is your doubt there?
If you can open that, sir, in your screen, then I can.
1 second.
Sir, can I share this notes?
Yeah, I will be sharing on the our Google discussion form. I will be sharing after the
Once the
session.
meet is over.
Yeah.
Okay, sir.
So is my screen visible to you?
Yes, sir.
Yes, I have this open with me.
You go to that, sir, yield curve, that where you have solved some problem.
This one.
No. Go.
This
Sir,
one. Like at the end, this is the end.
no,
Okay.
you use the information in your live session, sir. That note.
Okay, in the live session. So let me check if I have those notes with me.
Actually, sir, in that live session note, there is a table where the different period, say 91 days, 3 months, 1 month,
Yes.
this treasury bill and government security for 1 year is given.
Yes.
And there is some, I just want to ask a question. The slope you said we have to calculate from the given information, but the problem you have solved, nowhere you have used that means slope point in between after calculating. Whatever value it's given, you have calculating from that. I don't know if you can open that. I
So,
can
so
tell you.
let me show you here only. Okay. Let me. So there, like, let's suppose some numbers were given for like 3 month, 3 month, 6 month, 1 year, and in the example which I gave you, there were directly 10 year, correct, and 30 year
Yeah.
more. So there were some numbers given. So it was like 6.7%. It may be 6.9%. I am just taking some numbers. 6.4%, and this was also 6.35%, let's suppose. So if I draw what I was saying from like 3 month, 6 month, 1 year, and like if I'm taking the same differences, then here will be 10 year. So what I was saying, so to calculate a, so let's suppose this is 6.7, this is 6.9. Okay, so these are the 2 points. So the point which I was making, like, so if I am supposed to use 2 year rates of return, but I have not give, this is not given to you, you were given only 1 year and 10 year, then what
Oh,
you
then
can,
I have to calculate the slope. Yeah.
yes, then you have to calculate you like the assume that the yield curve is linear between these two given points, and by using the like the this linear equation formula, you can calculate 2 year. So that would come out to be 6.72 something like. So accordingly, like, so if taking this rate of return. I think in that session we calculate the forward rates using the yield curve. The same analysis we did in the lectures with professor also. Like the professor also solved for forward rates using yield curves.
Okay.
So
Okay, sir.
was this your doubt? So like if a particular like the annualized rate of return is not given to you in yield curve, in that case, like for any two given points, you assume yield curve to be linear in between them and then use that linear equation to calculate. So for example, for 5 year also, you can calculate using this formula. By
So I can give you the figures if you want. You had said the rate is 6.53 for a 1 year bond, that's 364 days, and 6.75 for a 10 year.
yes. So
And with that, you have taken out the slope, which
yes,
was, I mean, for a 2 year bond, we had to take out. So the
yes,
slope and the 2 year was coming to 6.554.
yeah. So those were the numbers. So
Yeah.
accordingly, like for that, like because we needed 2 year and 2 year
Yeah.
bonds analyze rate of return to calculate like the 1 year forward
Right.
rate of return.
For the
So
2 year, you did a holding, which was
yes,
1.0665 square. And
yes,
1 year, we already knew 1.0653. And with that, you took out the forward rate of R1, comma 2.
yes,
So,
correct.
right.
Okay. Okay, sir.
Okay. If you have any other questions, please like to post them into our Google form. No, like to so that is more accessible to me right now. So I will be available on Discourse forum as well. So on that Discourse forum, like it may be a slight delay, but on Google discussion, our platform that I will be answering, like I can answer that using my phone also. So I will be like available there, and I will be sharing these notes, today's notes, like in some time in our Google form, like the Google discussion forum.
Sir, I have a couple of questions. Can I ask, please?
Yes.
The first question is, if we look at the conceptual questions of all the graded assignments
Hmm.
and also those that are given in past quiz paper,
Hmm.
will that be adequate for the forthcoming quiz? More or less, I think conceptual questions will be on
So
similar
that
topic.
gives you an idea like what type of questions are asked in the exams. In the GS, like we do not give the questions like which are you can directly solve from the slides, because you have slides available to you when you are solving the graded assignments. But
Yeah.
in the quizzes, like we can directly pick up from the slides because slides will not be with you when you are solving the quizzes. So
Yeah.
that difference you can see in the previous terms quiz also. But
Okay.
going through slides, I think that would be enough if you have like the gone through the lectures once, and if you revisit the slides once, I think that would be enough for your.
Okay. Okay.
Okay. Any other questions if you have? So all the best everyone for your quiz, and in the next week the I will not be available on Saturday, so I will be taking your session on either on Friday or Sunday. So is Sunday okay for all of you, like Sunday 6 to 7 p.m. for next week and week after that also? Yeah, I will be
Yeah,
posting
it's
like after the like on Monday I will be posting regarding that on our Google form, Google discussion forum regarding this. Okay, so next session we will be having on, I think it will be on 2nd of March. Okay, 2nd of March,
Yeah.
6 to 7 p.m. and we will be using the same meeting link which we are using today. And
Okay.
the week after that also, like on 9th March, we will be having the session. Okay. On Saturday, next to Saturday, I have some other commitments, so I will not be available.
Sir, one small thing. See,
Yes.
tomorrow is the only day left for us for the quiz. So what I'm requesting is, which forum should we use in case we have a doubt? How, where will you be frequently available? Is it
Yeah.
GSpace or Discourse?
GSpace, I will be available frequently. And in
Okay.
Discourse forum also, like I will be checking, like I cannot frequently check because, so in GSpace I will be available on phone also. So I will be responding on GSpace frequently.
Okay.
Okay then. All
Thank
the
you, sir.
best everyone
just
for
one-
the yeah.
Thank you.
Yes, Samit.
Just one thing, sir.
Yes.
For that problem that you are solving with the GP series, 100 plus 100 into 1 plus R and the series is continued. In our compounding interest formula, where we use the C into 1 plus R whole to the power n, in that R or n, if I change this number to daily compounding, will it come? Means what is the difference?
I did not understand.
But
But
actually, what he's saying is if you take 100, but that Samit is an annuity. This is an annuity, it's every day. There it is one-time deposit of 100 and you take after 365 days or whatever. Here you're depositing every day.
yes.
So annuity will be
Oh,
different.
I am missing that deposit part, right?
Yes. Yes.
Okay. Yeah.
So I think there is one question in a GA also, like where it says like you keep on depositing some amount and in how much time you will become a crorepati or millionaire, something like that. In that question, we use the same concept. So I would request you to have a look at the solution of that question. And that would help you understand this concept.
Yeah.
So why can't we make use of annuity here?
Because
I think it is.
annuity, like annuity formula, that is for present value, and here we are supposed to calculate the future value.
Okay.
Yes.
Okay. Thank you, sir.
Okay. Thank you, everyone. Thank you for attending.
Thank
So
you, sir.
please let me know if you have any other doubts. So I will be available on our Google Space, G Space, and I will be sharing today's notes in sometime on G Space only.
Thank you, sir.
Sure.